Okay, so we're going to talk about financial ratios, specifically debt equity and gross debt ratio. Um, the most common ones would be GDSR and TDSR. Okay, so for this lesson, I would recommend you have at least 3 or 4 different highlighters to make it easier to see what's going on. So let's look at some definitions. So the first thing you need to know is the difference between an asset and a liability, right? Asset is position that can be turned into cash to cover the liability. So the actual items you own could be investments, it could be a savings account, car, boat, you name it, that would be considered an asset. Liability is money owed, right? Or monetary obligations. That would be like the loan. So for example, you can buy a car and get a loan for it. So actually the value of the car would be considered an asset, but if you owe money on it, that part would be considered a liability. Mortgages, for example, right? If you own a house, the value of the house is an asset, but at the same time, the mortgage, which is the loan on it, is the liability. And you'll see how that works out later. Okay, so next is net worth. It's the difference between all assets and liabilities. And if you look further down, I don't know if you can see it way down here, you have the formula for net worth right there. I'm not going to highlight it just yet, okay? Essentially, if you're able to sell all you own and pay all your debts, how much money would you be left with, right? So if somebody has a net worth of whatever, it's kind of saying if you kind of liquidate everything, you sell everything and pay everything off that you owe, right? So you sell what you own, you pay off what you still owe, that left, whatever's left is your net worth, okay? Debt equity ratio, right? A measure of financial health based on your net worth, right? It's based on your net worth. As a general rule, this ratio should not exceed 50%. So it's very important to highlight that, not exceed 50%. So it's kind of like what we call the magic numbers. And I'll write it down again by the formulas. The gross debt service ratio, which is what we know as the GDSR, okay? The percentage of your gross income required to cover payments associated with housing. Payments include mortgage, principal, interest, property taxes, sometimes include secondary financing, heating, condominium fees, or pad rent. As a general rule, this should not exceed 32%. Okay. Total debt service ratio. Of course, the train has to come now. The TDSR, it's the percentage of your annual income required to cover all debts and housing costs. Very similar to GDSR, except with the other debts are added in. As a general rule, should not exceed 40%. So we've got 50, 32, and 40. But these ones are very close to each other, right? So this ratio, when we calculate it, is just taking basically the housing costs, right? It's taking housing, which would be considered, in general, you would go with a mortgage payment. You would add the heating. You would add the property taxes. Every house or condo, anything that you own needs to pay property taxes. Plus, this is optional, but if there's a condo fee, a lot of times, well, I would say every single time you buy a condo, you will be paying monthly condo fees, right? And that goes into maintaining the whole building, right? So, but this is not always there, right? So if it's not mentioned, just forget about it. But this would be considered the housing costs, right? Housing costs. So basically what this is saying that all of these combined should only amount to 32% of your income to protect yourself, okay? I'm gonna keep going. The total debt service ratio, it's basically housing costs plus other payments, right? other debt, right? So you take all of these and you would add any other loans that you have, right? And that's supposed to be less than 40%, right? So if you combine all of your housing costs and any debt that you're paying, that should not exceed 40%, right? So some banks use both of these. These are kind of called stress tests, right? Sometimes they only use one of them, okay? But basically, for our intents and purposes, if you're above 32%, you would not be qualifying for the mortgage, right? Or if you're above 40%, you would not be qualifying for a loan or mortgage for that matter, okay? Here are the formulas. This will be required for the test, right? So look at net worth, right? You would have the net worth is basically taking all of your assets and dividing and subtracting, sorry, the liabilities from it, right? So I will do liabilities. I will use a reddish, so that's kind of like not good, right? There. Liabilities and assets, if you subtract them, that's what we consider our net worth, right? And I will use a different color for net worth here for the formula section. So net worth also comes back when you're figuring out the debt equity ratio. Net worth is right there. And the liabilities would be right there. So the liabilities come back. So net worth has two things that you need for debt equity ratio. Okay. And for debt equity ratio, we take all of the things we owe money on, we subtract the mortgage. It's almost like we're not considering the mortgage because it's known as an appreciating asset, right? So we want to see, like, if you just look at the regular debt compared to your net worth, where are you at? So this is supposed to be less than 50%. The gross debt equity ratio, the only thing I want to highlight here is the fact that to make sure we get this right, we have everything in monthly amounts. So for gross debt, so for the GDSR, it's monthly mortgage payment, monthly property taxes, monthly heating divided by the monthly income. And we multiply that whole thing by 100 to get it as a percentage. And we want that to be less than 32%. Total debt equity ratio, everything stays the same for the first three. I will still highlight the monthly part because if it gives you the annual or the yearly amount, you need to divide it by 12 to get it into a monthly amount. And then I will just kind of circle this. Okay, that's the only difference from here to here is that you're also including any other monthly payments that you're making on anything else you owe. It could be credit card, car loan, you name it. Okay. So what's missing on the GDSR is that if there's a condo fee, you'd add it to these three, but these are always the big three monthly housing costs. So we're going to call this housing costs. Okay, so these three should not be more than 32% of what you make. So for example, if you were to make 70,000 a year, we divide that by 12 to get our monthly amount, right? So it's 5,833, right? If you multiply that by 0.32, your mortgage, your heating, right? Mortgage, property taxes, and heating should amount to at most 1866.67. That would put you at exactly 32%, which is still okay, but we would like it to be below. So for our intents and purposes, we would say that you do not qualify for the mortgage if you're above 32%. You would not qualify for a loan or a mortgage if you calculated TDSR, and if this should be below, right? That's why I go less than 40%, but if it's above, it would not qualify. So these are your magic numbers. Magic numbers. Okay, 50, 32, 40. and you need to make reference to those magic numbers when we're asking you whether or not that person is financially healthy or whether or not the bank is likely to approve a mortgage, right? So these are there to kind of check your financial health, but as also used to determining whether or not you qualify for the mortgage. Okay. All right. Enough talking. Let's go. So these formulas you should have for the test. And here's an example that's already worked out for us. Okay. So your monthly mortgage payment is $1,350. It's already a monthly amount. Your monthly property taxes is already also figured out. So it's monthly and it's monthly. Very important, right? Your heating costs are $100 a month. So all three housing costs are already in a monthly amount. Your annual income is $67,000. That's a problem, right? We need to turn that into a monthly amount. In addition to housing costs, you have a personal loan with a payment of $250 per month and a credit card debt on which you make payments of $300 a month. So what if it asked you to figure out the GDSR, right? So what if it asked you for that? So before I do anything, GDSR, you see already the worked out part, right? But it's just mortgage, heat, tax divided by income, okay, times 100. That's what, so you're going to use this formula. There are no condo fees. If there would be condo fees, you add it to the top here. What else do I want to say? Oh, this is the trick here. You either have all of these, every single amount as a yearly amount, or you have every single amount as a monthly amount. Because most of the time, there's like one annual amount there, it's easier to just turn that annual amount. In fact, all my examples turn everything into monthly. Okay, but that's the trick here. So anyways, we take our 67,000, we divide it by 12 to get this much per month. This is your income. Okay. Then we use the GDSR. So GDSR is equal to, we add up the monthly amounts, we divide it by the income, we multiply it by 100, it shouldn't say percent. Right, so add the top, make sure you add the top first, don't just go ahead and divide. Show me the work. So you get this times 100, and also this number is going to come in handy, you'll see in a bit. You multiply it by 100, you get 31.97%. That's less than 32%, which is in our books, that's good. You're still below the threshold. You would be approved. Okay. If it's a TDSR, it's asking for TDSR. Okay. We still add the same three values that we had above, but we have two new, right? These are the other debt payments, right? These are the debt payments you're making, $280 a month. So you basically, we could have just taken the 1785, plugged it in here. Maybe I will do that in a bracket here. 1785. Okay. You take the 1785 from up here, you add the other debts, multiply it by 100. And you get 2335 divided by the income, so the income stays the same. Then we multiply it and we get this, which is above 40%, right? Not good. So the TDSR is here, the GDSR is there. So when you just look at the housing costs, this particular, in this case, you would be okay. When it comes to all debts, so the housing and the other debts, which is the total debt service ratio, you're not so good. Mind you, this is still okay, but you're kind of getting very close to the max. You kind of want to give yourself enough wiggle room, right? So ideally, right, you would probably, for example, right, ideally you would probably want this to be maybe, 25%. And this probably to be in the, I don't know, 30, 30 or 35%, right? Um, you want wiggle room because these are just maximums, the 40% and the 32%. That's when you max out on housing. You're basically using, if you get right to 32, you're almost using a third of your income for housing. And in this case, you're using almost like 40%, which is close to half, but it should be less than half, right? Of your income on housing and other debts. So if you have too much debt, this percentage is too high, too much of your income is spent on repaying your debt, okay? All right. I have a little statement here. In this example, the GDSR is almost exactly at the limit, but the TDSR is over the limit. So the person would have a difficult time getting a mortgage for this amount. Or if they already had this mortgage, they would be advised to reduce their debt load. Okay. So that's what you could do. You could also increase the income. How can you do that? By getting another job or a better paying job or a cosigner. So if somebody cosigns, their income would be included as part of the total income here because it's kind of considering the whole household. So whoever cosigns is part of this. So the bigger your income, right, that'll reduce the percentage that you owe. Anyways, I try to keep this. Oh, I'm over already. Sorry, guys. So let's just look at the mortgage. Oh, sorry, assets versus liabilities. So I just did a little quiz here. It used to be a Google form, right? Is a mortgage an asset or a liability? It would be a liability because a mortgage is what you owe on it. Is a car you own an asset or a liability? Is an asset. So you can pause and see if you get these. Savings account balance, that would be an asset. Stock portfolio, an asset? Yes, that would be an asset. Credit card balance, that would be a liability. You owe that. Line of credit balance, you also owe that. Cottage you own, that would be an asset. Okay? Smartphone agreement, right? So you're kind of locked in. It's actually considered a liability because you don't own it yet. Is a GIC an asset or a liability? That'd be an asset, right? So there's your quick check to see if you understand the difference between an asset and a liability. Okay. Calculated the GDSR, sorry, next page. This is GDSR, something went wrong there, and the TDSR for the following household. So we're going to do that. And I will probably just scan this one. This is also figuring out the GDSR, but before we do that, we need to figure out our monthly payment based on the information we're given here. And it's also a condo with condo fees and stuff like that. Maybe I will just do this one. And then I would like to give you an example of net worth on the back of this. So let's skip this question here. I'm just going to go straight to this one. And you know what? I will work it out and then just go over it, explaining what I did. So here it is, just worked out already. So for this, in this case, I went with the GDSR. The heating, property taxes, and mortgage were all in monthly amounts. And of course, the payment is always principal and interest combined, right? That shouldn't surprise you. But I just added those three. I got that, and the income is 6,000. It's also a monthly amount. What is gross income? That's before taxes, right? So they kind of look at your income before taxes are taken off. So then you take that divided by that, you get 24.11, which is less than 32%. So this person is healthy, financially healthy when it comes to that. The total debt service ratio, I take this number here, I just add the $400 a month on consumer debts, right? I add that here. I don't know if you want to. Right, I use that one, and I use this 14 right? So you should be able to quickly figure out the total debt service ratio just like that. So you adding these two amounts gives you this divided by 6,000. You're at 30.78, which is less than 40. So in this case, we would say bank most likely to approve this mortgage. Okay, or you can just say if it's asking about financial health, you would also say the same based on those magic numbers, okay? So let's see here, lots of stuff going on here. If you read this carefully, based on the interest and compounding periods and its 25-year mortgage, I figure out the payment, which is this. Okay, right here's the payment. It's a monthly payment, so 12 compounded semi-annually, that's 2. And B is asking to calculate GDSR. Here's that monthly payment I just figured out. I'm using that as part of my GDSR. Sorry, it's a little messy, right? But I figured out my property taxes, what it is per month, and I add the condo fees of $395 per month, and I almost forgot about the 60, which is the heating. Usually at a condo, it's a lot cheaper than a house, right? Because it's a bigger building. So you add up all those, so you don't forget your condo fee. Perhaps I should tell you where this is from, right? Condo fees also considered a housing cost. You add all that up, you get 25.99, which is less than 32. You're good to go. For the TDSR, I take that number I got up here, right? I use it again. This number comes back, but I'm also adding the 400 and the 250 that I'm paying on these two loans, right? So that's the total service ratio. So you add everything up, you get this divided by the income. Oh, by the way, I had to figure that out too, right? The monthly income, right? It's all monthly, and then it's 33.08, which is less than 40. So will be approved since both ratios are below the threshold, right? So that's that. On the back side, I'll just walk you through that as well, because I worked it out. Trying to keep this video short. I already went over. I apologize. So for this, it's quite easy. Net worth is just assets minus liability. That's 35,000. Okay. For B, it says if Tracy borrows 60,000 from the bank, right, to purchase a car, determine the new values of the assets, liabilities, and net worth. So watch this. Your assets go up by 16,000 because we're assuming that's what the car is worth, right? So the car itself adds to your assets. The liability goes up by 16,000 as well. Okay. Both of them go up by 16,000 because you owe all of it, but at the same time, so it's kind of like nothing really changes, right? So if you do the net worth of the new assets and the new liability, right, it's still 35,000 just like before, so nothing has changed. Once you start paying off more of that loan, then obviously your net worth is going to go up. Okay. And this last chart here, it's asking to figure out the net worth here based on this chart. So notice what I did is I first identified which ones are my assets and my liabilities. I added up all the assets here. I added up all the liabilities here. To get the net worth, I just go assets minus liability. So it's a positive. It could be negative. Okay, that means you owe too much. And so this is my net worth. Then it's asking to figure out the debt equity ratio. If you look at the formula, it's all the liabilities minus the mortgage. Okay, so let's see if I can. First of all, the net worth is part of this formula, right? The 212 is coming from there, and the 201, this number right there is your mortgage. So we take the mortgage away, all of the liabilities, everything you owe minus the mortgage, and we divide that, and it's 11.06, which is less than 50, right? Less than 50%, which is very good. That's it for this. If you want to do a few questions on your own, there are more on the following pages. I'm going to try to work on the key for this and also the keys for the other pages that I assigned, right? If you're watching this, let me see if I can make this work. It's probably not going to work, is it? So there are your finance review pages there. Okay, so make sure you work on that. That's it, that's all.